Hey economists! Exciting news! Global Forecasting School is hosting exclusive bootcamps in gorgeous Algarve, Portugal. Picture this. May 6th to 31st and June 3 to 28th. Learning? Surrounded by stunning landscapes of Algarve. This time, we are specializing in non-traded sticky price and not the fat till book for our new GFS students. It's an unforgettable learning experience. I've been there, trust me, it's incredible. Next stop, the Dilijan Research and Training Center in Armenia, my hometown. A place where ancient history meets modern education. Join our summer school from July 1st to August 30th for a dynamic learning environment. Develop key technical skills, enhance your research abilities, and receive mentorship from the best in the field. Improve communication skills in an environment all about continuous learning. Don't miss out on these incredible opportunities. Hit the link below to learn and apply. Your future in macroeconomics awaits. Seize the chance to shape your future with Global Forecasting School. Furthermore, over a dozen macroeconomist positions available at the Central Bank of Armenia. We are crafting the best of the bests to develop and implement FPAS Mark II framework, a prudent risk management approach for monetary policy. If interested in these positions and summer program, please reach out to Heike Avedisyan, Head of Macro Directorate at the Central Bank of Armenia. Check the link below for details and apply. For bootcamps in Portugal, connect with asyakostanyan. Explore and apply on the Better Policy Project website. Find the link again in description. Don't miss these opportunities. Good luck! We are starting a new research initiative called Orphanides Rule. Professor Orphanides will be leading our research efforts in Mark II to identify simple robust rules as a cross-check. Individuals interested in this research are welcome to join our bootcamps and summer school, where Professor Orphanides will deliver a dedicated lecture on the subject. Please enjoy his presentation at the symposium.
But let me start by saying that what I really appreciate about the prudent risk management approach to monetary policy is that it recognizes the risks of sticking with what academics would call optimal policy, and all of the efforts we see in academic journals using toy models and trying to devise policy that is based on assumptions that may or may not hold in practice. And that's fine for academic publishing, and simple toy models can actually help build a lot of intuition, but it can be deadly for practitioners to then take the results from that work and then try to formulate a policy with it. Now I think I can share my slides. So let me go to this one. So I hope you can see my slides now. Yep. Okay, good. So the aiming to achieve what is optimal under assumptions that are not to be overly simplistic can be counterproductive, and this is the temptation I would warn against. That would be the basis for the one recommendation I have, which I'm pretty sure is going to be very similar to what Doug mentioned and John Taylor would have brought up earlier on. the temptation to try to find optimal policy can instead be the cause of major error. And you guys already mentioned, it has been stressed repeatedly at this symposium, how important it is to deal with uncertainty. And this is where I'm going to remind you of the San Diego meeting. It was almost 20 years ago. It was on January 3rd of 2004. This is when Alan Greenspan gave his address on risk and uncertainty in monetary policy. And he started with that very nice summary sentence. I'm going to quote, "Uncertainty is not just an important feature of the monetary policy landscape, it is the defining characteristic of that landscape." So yes, Dak, a sentence like that, should have us and many others think hard about how we can write papers to address this point. So there is a lot to like in the prudent risk management approach monetary policy. Examining alternative scenarios is incredibly useful. What I want to do is focus on another element that I believe is important to ensure robustness, and that is the role of a simple policy rule that can be used as a cross-check. I'm going to provide an example based on the Fed's post-pandemic inflation experience. And my main recommendation is going to be really to add a simple policy rule as part of the package, following a criterion for good policy that was developed two decades ago by Jan Vikstad at the Norges Bank. And if you haven't done it, if you're not aware of it, Norges Bank at the time was at the beginning of implementing inflation targeting. In the terminology that you are following, it was an FPAS Mark I central bank. And at the time, Jan was the chief economist at the bank, trying very hard to develop a framework for good policymaking, much like what you're doing and what we're discussing this symposium, with the idea being to consider the challenges faced by policymakers in practice and try to ensure that policy would be robust. So in assessing this, he came up with a list of criteria, and I highlight here what criteria number 6 is. You can see it on the screen. It says you can have your framework. It can tell you what the optimal path is going to be. That's going to look good and everything. But then criteria number 6 says it may also be useful to cross-check by assessing interest rate setting in the light of some simple monetary policy rules. If the interest rate deviates systematically and substantially from simple rules, it should be possible to explain the reasons for this. And this is in order to discipline the policy process to avoid what may end up being major mistakes. So develop a benchmark and use that benchmark to make sure if your policy deviates a lot from that benchmark, you have a good explanation. So under a simple, robust rule as a benchmark, it's useful to. There is another issue that this would address, which is the fact that decisions are taken on a meeting by meeting basis and discretion. And this is a framework that every central bank is following by necessity, but it opens the door for some other challenges that we face in practice. Behavioral biases that sometimes creep up, other influences that can be important from time to time to policy. So the fact that we are taking decisions on a meeting by meeting basis opens the door for these things. This is one of the elements that creates some disadvantages with discretion, and having a simple rule would actually help maintain monetary policy be more systematic. Now, the whole point is simply to cross-check the proposed policy setting and to see if there is a deviation, as Jan Vikstad told us 20 years ago. Make sure you have a coherent explanation. And if the explanation is not convincing, then perhaps the policy setting should be rethought. So this is the whole idea of having a simple rule, making it public, making public the prescriptions, and communicating the deviations from that. So let me show you the example. We are all aware of the inflation experience after the pandemic. If you look at the U.S., it's pretty clear. Just look at the inflation picture that the Fed lost control of inflation, at least for a while. Now, in my view, this was a policy mistake that by now the Fed is back on track. I will show that to you in a minute. But it was a policy mistake that in retrospect, we can all agree, even the Fed officials are telling us policy was too accommodative, no question about that. The question is, was it evident in real time? Is this something that a more robust framework or guidance from a rule could have helped? Well, actually, we could have seen in real time that policy was too accommodative. So what I have in this chart is a proxy of the real federal funds rate. This is using year-ahead real-time projections from the Service of Professional Forecasters. This is a measure that had been available to policymakers in real time in the U.S. since the late 60s. Of course, inside the central bank, the benchmark inflation forecasts can and indeed are being employed to assess what the real interest rate is. So this is just a real-time rendition that would approximate what would have been also evident inside the central bank in real time. And you can tell from this that indeed in 2021 and early 2022, the real interest rate by this proxy was at a historic low. And this is an ex ante measure of the real interest rate. This is not an ex post measure of the real interest rate. So, this is a picture that is quarterly. It's a proxy. It's not exact. Doug mentioned earlier, more recently, and especially in advanced economies, and even in many emerging economies, we have better data. We have financial data that actually allow us to track these things much more precisely. So, actually have in this figure, a picture of the daily market-based ex ante 2-year interest rate. You can construct this by looking, the black line is the inflation swap 2 years out, and comparing that with the OIS 2 years. And you can see the policy mistake evolving in 2021 as the economy was coming out of the pandemic. Inflation expectations were rising very fast. The Fed decided to actually peg the nominal interest rate at 0 for too long until March of 2022. This is something Milton Friedman has told us in 1968 we should be very careful not to do, but the Fed did it anyway. And while he was doing that, the real interest rate, this is the 2-year real interest rate, kept falling and falling and falling and falling. Well, we know what that does. It's not magic. This added to the inflationary pressures, and this is the monetary policy contribution to the problem. So this is the error that exposed. We can all agree was there. The question is, I'm not going to say, by the way, that all of the inflation would have been avoided if the Fed had not committed this error. This is just something that contributed to an overheating of the economy. This is the component that could have been avoided. And the question is, could this have been assessed in real time? Well, of course, people were following these things. They knew that the real interest rate was too low. They must have had some modeling, some concerns, some advice that was telling us, it's okay to take this risk. Let's take the risk of inflating the economy. What I'm asking is this something where a simple rule would have helped improve policy by giving a warning on what the Fed could have done? So I'm going to show you an example. This is an example where I have it here on the second line. It's a one parameter difference rule, very, very simple. This is really following on the policy research that has been done in the last few decades, particularly the seminal contribution by Ben McCallum in 1988, who argued, let's use a simple rule with a monetary base to track nominal income growth. And then John Taylor's 1993 contribution saying, yep, let's have a benchmark rule and make sure that policy becomes robust with that. So the example I have here is a policy rule that we had developed at the Fed when I was there more than 20 years ago, drawing on that experience. Again, what does it say? It says, well, look, just monitor the economy and see whether nominal income growth, this is N, is growing too fast or too slow relative to what is normal, the benchmark natural growth rate of the economy. This requires some assumptions. You need to have an assessment of what potential output growth is. We have that in our models. We need that. We have the inflation objective of the central bank, so we can add them up. We get an assessment of what nominal income growth is. And we need to assess the current state of the economy, meaning what is happening now and in the next couple of quarters, really. We know that what happened a year ago doesn't really matter. What we need to see is where is the economy now? Where is it going the next couple of quarters? This is how we use the best judgment of the forecasting team at the central bank, not using models to tell us, what do you think is going to happen 2 years from now? No, just use the best judgment, which is incorporated in short-term forecasts, and then see what the imbalance may be in nominal income growth relative to potential output growth plus the target. So these are the inputs to the rule. This is real-time assessment. Now, inside the central bank, they can do this with their internal forecast. What I'm doing here is showing you the picture based on publicly available data. These are the median several professional forecasters' projections. They're published by the Philadelphia Fed in the second month of every quarter from 1992. It's very simple. Where is nominal income? The blue line. How does this compare with the natural growth rate of the economy? If it's too high, tighten a bit. If it's too low, ease a bit. That's all. And this is what can form the basis of a policy rule. Whatever is the interest rate you had the previous quarter, simply use this as a benchmark to add to that. What are the policy prescriptions you get from this, and how does that compare with the Fed funds rate? Well, actually, the Fed has not deviated that much from this very, very simple rule over the past 30 years, all the way until the pandemic. And this is the lesson we can pick up from this. If you look at this, yep, the Fed actually has been tightening and easing policy in accordance to these rules at the zero-lower bound. When this policy rule was telling you have to ease policy more, the Fed was actually doing quantitative easing, which is just fine. It's exactly what you're supposed to do. But then you see that at the very end, we have a problem. In this 30-year period, we have one period of a very large deviation, and this is what I want to focus as an example. I can actually show this to you in greater detail here. These are the inputs to the rule, and you can see late 2020, the economy is recovering, telling the Fed effectively, well, you need to start considering when you're going to start normalizing. During 2021, in every single quarter, this policy rule was telling the Fed, well, you guys, you need to tighten by 100, 200 basis points just to make sure you are not very far away from what would be normal policy. And of course, the Fed didn't do it. And the question comes back, isn't this an example of a simple rule that could have helped the Fed effectively be more robust in its approach? Now, my reading of this episode is that the framework that the Fed has in place was not resilient, and we have an example with the post-pandemic inflation of how it failed. And this is an example of a lesson that in the next revision of the Fed's framework, I hope they will actually take this into consideration and go back and take better account of the advice from Ben McCallum and John Taylor and many others about incorporating advice from simple policy rules. So the one recommendation I have for the framework is that including a simple, robust rule in the analysis can help defend against many of the pitfalls that we have associated with meeting by meeting discretionary policymaker, it forces the policy committee to explain when there is a major deviation from a simple rule. I think if the Fed committee were forced to explain why they were deviating so much during 2021, they would have recognized that they couldn't really explain, and they would have actually acted faster. I'm giving you one simple rule as a starting point, but of course, policy research at each central bank is what is necessary to ensure that you have a robust starting point, and this is where we need policy research, as we've shared, is part of the framework, continuing evaluation over time to see if the benchmark that has been adopted remains appropriate, and whether it needs to be adapted from time to time.